Hi, it's Connie from Prosperity Finance. How are you? My goal is to give you the timely insights and tips to help you master the game of finance and ultimately help you achieve your goal. Now, before I was asked by many people that, let's say, you don't really have much income, but you have a property without any mortgage or little mortgage. You want to know why you can't borrow from the bank because it doesn't make sense. A bank has no risk, right? You have a mortgage for property and they can take another property when you purchase another property. So they have two property and you only borrow $500,000 against $2 million, dollar properties. Now, the reason the bank can't give you the loan, despite they have no risk, is because they are bonded by the Credit Contract and Consumer Finance Act, also known as CCCFA or CCCFA. So with that act, it gives the banks kind of requirements to make sure they are responsible lender. They don't put you into a financial hardship. So in that example, if you don't have income, you can't demonstrate your servicing ability. Therefore, bank in breach if they give you a loan. Okay? Yes, they are safe, but they're in breach of that CCCFA. Now, you probably think why I'm talking about this today. Well, it's very important because recently there was an amendment bill for CCCFA, and as a result, banks have to comply with the new regulation from 1st December. So bank already start working on their process and lending policies and the paperwork required to make sure they are comply before the 1st December. Now, as a result, your borrowing capacity and requirements can be different. So today I'm going to talk about 5 areas that was affected by CCCFA so that if you are aware now, you can better prepare and get the best possible outcome when you're ready to borrow. So let's start it now. The first point I want to discuss is the rental income. So investment property is also a business, okay? But unfortunately, government made an announcement early this year and saying, hey, the interest costs can no longer offset the rental from 1st October for any property purchase from 27 March 2021. I know it doesn't sound right, but this is the rule, right? So as a result, some banks start changing the way they recognize the rental income. Now, banks do not require a financial statement to be produced to recognize your rental income. They basically take a percentage. Now, before this CCCFA, so they take about 70 to 85% of the gross rent to take into account the vacancies, the costs associated with running a investment property, such as property management fee, maintenance, etc. But now they have reduced that percentage to a lower number so that they can, reflect the changes that the government made early this year. So what that means to you is if you have existing rental property or you're looking to buy rental property, the income will be less than before. Therefore, the borrowing capacity will be less. So that's about the rental income recognition. Now, ASB only recognized 60%, the lowest among other Aussie banks. So just the percentage, and so that you can be prepared and know which bank to go to for your own situation. The number 2 impact is to do with existing loan. So you probably think, what that existing loan to do with the borrowing capacity? I mean, paying the same amount every time. Well, yes, you are paying the same amount, but your repayment looks different from one bank to the other because they will calculate your existing loan based on a number of factors such as your repayments, your loan maturity date, etc. So it's the calculated figure rather than the actual figure. So before these CCCFA changes, some banks, for example, Westpac and Bank of China, if your loan are on interest only, you will get more lending with Westpac and Bank of China than any other banks, because the way they recognize the repayments is so different. They only add a small margin to your existing payment. So if you are only paying interest, the payment's pretty small. Compared to other banks, they will use principal and interest approach, and they also take into account your loan maturity date into accounts. But now they change as well, because if you only have 10 years to pay off the loan, it's 10 years. It's no longer 30 years. And if you have an interest-only loan, they will take out the interest-only period. So it will further reduce the amortization period, therefore reduce your borrowing capacity. They no longer have that benefits. So unfortunately, for people who have existing rental properties, your borrowing capacity would significantly reduced from now on. The next point I want to make is associated with the new loan. So the driven factor is the test rate. So what is a test rate? Test rate is a test interest rate the bank use to test your borrowing capacity. It's not the actual interest rate you're about to pay. Most of the banks have test rates around 6%, 6 to 7, some slightly less, some slightly more, but roughly about 6%, 6 and 5. So they want to see if you can afford the loan at this level, not at the current level. Okay, because they give you a loan for 30 years for most people, and they want to make sure you can afford that loan for the 30 years, not just for the next 12 months. So that test rates, some banks like BNZ has increased the test rates. So yes, your borrowing capacity will reduce accordingly. The good news is Westpac is the only bank actually reduced the test rates. So at the moment, Westpac is probably can lend you the most if you are first home buyers or you are the first time investors. Okay, but I'm not saying you should just go Westpac. There's other consideration as well. But in terms of borrowing capacity, it's more likely Westpac is very competitive. Now the next point is to do with credit cards, consumer cards, and the popular payment method, buy now, pay later, like Afterpay. Now, when I started becoming an advisor, that was almost 10 years ago, if you have a credit card, as long as you pay off every month, there's no impact. But I can't remember when it was changed, but probably 3 or 4 years ago, bank changed the policy for recognizing the credit card's expenses. So they basically use the limits as a measure and apply a percentage, normally 3%. So if you have 10,000 credit card limits, they will allow $300 every month as credit card interest expense, regardless if you pay off or not every month. Okay, so the higher limit you have, the more impact it has on the borrowing capacity. Now it's getting even tighter. So there are some banks apply a higher percentage of your credit card limits. So if you don't have to have a higher limits, don't do it. I know sometimes the banks, have different departments have a different priorities. With the credit card departments, if they see you have a good credit history, they will send you a letter and say, hey, do you want to increase because you are a really good customer, you have a good account of conduct. But then it comes to lending. The lending department say, hey, you have lots of credit cards, so you can spend all if you want. So I'm going to take into account as extra expense. So it's going to punish you for your borrowing capacity. So unfortunately, this is the way they operate. So if you don't really need it, don't take a high credit card. You can reduce before you apply for the loan. Now, same apply to store card like farmer's card. Like store card has a limits. It works similar to the credit cards. It's also get tightened, so it will have an impact on your borrowing capacity. And finally is the buy now pay later, like Afterpay. It's really popular, especially it doesn't really have any associate interest, etc. So why not? A lot of people take it. I do it as well. But if you're looking to borrow money, don't take it. They will treat it as a liability, treat it as a loan. So yeah, don't do it if you're looking to borrow. Okay, so that's to do with the cars and buy now, pay later. And finally, I want to talk about the living expense as the last point. So living expense, why is it important in the context of CCCFA? Well, you may think you will spend less when you have more loan, but bank don't believe that. Okay, so bank has their own calculated living expense based on your family structure, like how many adults, how many kids, and they're also based on your income level because they believe the more you earn, the more you spend. I know it's not true for everyone, but this is their policy. This is their belief. Okay, so they have a minimum living expense, and then they compare with your declared expenses, and also look at your bank statement to verify your declared expenses. If your declared expenses or bank statement showing you spent more than the bank minimum, then they take your living expense number. But if your living expense, the actual living expense, is less than the bank minimum, they use their number. So it's always the most conservative approach because they have to comply with the CCCFA. So now they have this technology to scan your bank statement and see what you spend on under each category, like food, entertainment, travel, everything. So they can see. So if you're looking to borrow money, be careful what's on your bank statements, okay? Because it will have very big impact on your borrowing capacity. They will also require you to declare in more details. Like they have a lot of expensive bucket you have to fill out, very, very scrutinized at the moment. And some banks even ask for evidence. For example, they won't ask you for the council rates evidence, the insurance evidence, rather than just a declared number. Okay, so be warned, it's more paperwork, more question. So that's why it's taking ages now to approve a loan. But bank have to comply with the regulation, unfortunately, and we have to apply as a financial advisor, and you have to apply, otherwise they will reject your application. Okay, so I guess we can't really change much, unfortunately, the way we get treated now these days. I think it's overkill, but if you want to borrow money, hey, you have to comply because there's only so many banks in New Zealand, monopolies. But what you can do is to be familiar with those requirements and make sure you are well prepared. So when you need to borrow money, you get the best possible outcome. Okay, so I hope you find it useful today. Now, if you have any particular personal question, feel free to get in touch and we'll, give you our best advice. Okay, thank you so much. Please take care. I'll see you next time. Bye-bye.